Welcome to the latest episode of the Street's Stocks and Markets podcast. In today's episode, we're going to discuss the stock market's technical setup. Should the market have been surprised by the weekend's Trump EU developments? And does the market have it wrong again on inflation? And much more. I'm Chris Versace, portfolio manager of TheStreet Pro portfolio, and joining me this week to tackle all those items is TheStreet's Bob Lang. And for those who are unfamiliar with Bob, he also supplies his technical insights to the Pro portfolio. Bob, welcome to the podcast.
Great to be with you, Chris. Great to be with all the members and talking a little bit about markets. You know, things are evolving very quickly here with trade policy and inflation and lots of different things that are happening to change the direction of markets backwards and forwards. You know, just a week or so ago, it looked like we were headed for doomsday and headed for much lower prices. But now things have, pretty much turned around and maybe a little bit brighter future ahead.
Well, let's talk about that because, every Monday, I think one of the great things that you do for the Pro portfolio is you provide an updated technical look of the S&P 500. And you did that yesterday, just given the holiday weekend, came out on Tuesday. But you said something at the very end that I thought was pretty telling, and I want you to explain it. You were referencing the potential change in the inflection point of the MACD line, and you were saying that this could be good news for the bulls. What does that mean? Why is it important?
Well, I use the MACD, Chris, as an indicator to tell us changes of trajectory in the stock market or stock prices before they happen, not when they're happening or when they did happen. So that's an important point using the MACD versus any other indicators. It's pretty reliable. It's been one of the most better indicators that I've used over the years, along with several others. But the MACD is really one of the important ones. It really tells you what is the MACD? It's the moving average convergence divergence, and it gives us basically a trend of market movement in prices over 2 or 3 different time frames. And so in this particular case, I like to look at the basic standard default MACD, which is a 15 or 16 day versus over the 26 or 29 days. So it gives us about a read of about 3 weeks versus about 6 to 6.5 weeks. And when the short-term moving average is above the longer-term moving average, and basically that's what we have right now in the weekly chart, which I explained this weekend, it's a bullish condition. Now, what I like to look for, I like to go a little bit further, Chris, and I look for confirmation. And confirmation comes from another week or another bar for that indicator to confirm that previous trend change. So this trend change happened this past week. It was the first time, Chris, that we saw the MACD crossing, doing a bullish crossover since late 2023. So, I mean, that it's been a long time that we've had since we've had that shift or change in trajectory, but I think that's real positive for the markets.
And when you've seen this happen in the past, is it an indication of a powerful rally, or is it something that it's just something we need to pay attention to?
I think it's both. I think what really need to do to pay attention to that is understand that these market trends tend to last for quite some time. And what it simply means is that when you get this bullish signal from the MACD, you get on board and you just ride it out until it changes. And who knows how long that's going to last. And we had a very, very long period where it was in bearish territory, the MACD. But prior to that, we had a good 2.5 years where the MACD was in bullish territory. And, once it crossed over, if you rode that out and stayed with it all through 2024, you were in good shape.
All right, so let me just ask a framing question, if you will, because there are other indicators that are out there. We at the Pro Portfolio kind of talk a little bit about the relative strength index, and there's oscillators and other things. How do we kind of put these in order of importance if we see a turn in the MACD?
Well, remember something, Chris, when we talk about the relative strength of the MACD, these are simply conditions, they're not signals. The difference between a condition and a signal is the condition explains to you what it looks like at a certain period of time. It doesn't tell you necessarily what to do right? So if we look at a condition where markets are oversold, for instance, relative strength is down in the 20s or the 30s, it could last for a very long time. Conversely, we could look at an overbought condition when relative strength is, people look at the level of 70 and they say, okay, well, once the relative strength number hits 70 or 72 or 73, it's time to sell, turn the other way, and look for the markets to go down. Well, you know what? We could have a long period of time where that overbought condition lasts, and what ends up happening, if you pull the trigger and leave the market during that period of time, you could certainly leave a lot of money on the table if you exit that trade
Okay.
or
Okay.
investment.
So I guess what I'm hearing, Bob, is that you kind of have to be mindful of different indicators, what they each mean, and kind of use them to round out a fuller picture.
That's correct.
Okay. So, and the fuller picture that you're seeing right now seems to be more bullish than not, correct?
Yeah, you know what? We're slightly below 5,900 right now on the S&P 500, and the all-time high around 6,150 is less than 5% away from the current levels. And I think that we've had some other signals, not just the MACD, but also breadth indicators. Cumulative volume breadth, for instance, is a very important indicator that I follow to see if we can get to all-time highs. And that recently did hit an all-time high about a week and a half ago, sort of the middle of May. And what that tends to tell us is that when that indicator is at an all-time high, it's not too far down the road where the SP 500 and maybe the NASDAQ as well too will also hit tag a new all-time high. Doesn't tell you when, it just says just be ready for it.
Right. So, but if we kind of game it out, the market's had a really strong run. We know this. It's been recently over, close to being overbought, or some others at the street were saying intermediate overbought. I think Helene Meisler had that to say. So we might see a new high, but that doesn't mean we're going to see the market move 5%, 10%, 15% higher from here, does it?
No question, absolutely not. And one of the reasons why we won't see those sort of moves like that is, as explained by market volatility. Market volatility index trading at around 19.5 right now. That's actually, interestingly enough, that's about the historical average for the VIX. It's about 18.5 to 19.5. So if you look back over time, over past, say, 30 years, Chris, that's about the average number that we've seen in the VIX. So if the VIX isn't going to go down any further and basically reflect more complacency in the market, what that complacency is basically driven by people who have no fear that the market's going to go down. If the market is not going to accommodate that and the volatility index is going to go down, and likewise, if it's not going to go up, we're stuck right here and we're only basically looking for possibly maybe 1.5% move in the market. It's not that 5-10% that you're talking about.
Okay. So are you surprised by the lack of complacency? And I'm kind of asking this, tongue in cheek, because we've had some recent trade developments, right, between Trump and the EU. Last week, Trump saying trade negotiations are going nowhere. He slaps on this potential 50% tariff by June 1st. All of a sudden, mad scramble, things start to potentially break free. What else do you see on the horizon, Bob, that folks need to be mindful of?
Well, I'm starting to see this pattern develop, Chris, of wash, rinse, and repeat. Right? We get we get a shocking word from the Trump administration about trade or tariffs and so forth like that. People start to panic, and then they come back in and walk it back. You've talked about this endlessly about how the administrators or the politicians start walking it back because they're fearful that the markets are going to get out of control and start moving way too far to the downside, and it'll be maybe into the abyss or something like that. But all that panic tends to get reversed when something positive comes out, or the perception of some positive news comes out. We heard it with just a couple of weeks ago when the markets ran higher, when it appears that the U.S. and China have come to some sort of an agreement. And also this past weekend, President Trump came out and said, well, you know what, we can delay the tariffs for another 5 weeks, and then maybe with the EU, with the European Union, and maybe that'll cool things off a little bit.
So what's funny about that, Bob, is, we hear these threats, the market sells off, we see them walk back, the market comes back a little bit. Not much has really changed, not a lot of fresh details. It just seems like we're just, gyrating back and forth, back and forth. And I've said this before, that there are times when the market is going to trade day to day based on the latest headlines, the latest news flow. And it sure seems like we're back in that flow.
Yeah, and that really makes people nervous, and it creates a lot of doubt, a lot of uncertainty here, and as we've said, it creates a lot of worry when people are I don't know, but basically all in, perhaps in the markets, and showing a lot of the complacency. And what ends up happening is you get days like we had last week when out of nowhere you get some sort of an announcement and the markets start selling off in a frenzy here, and people just start heading for the exits. And then it's all about, well, wait a minute, hold on. You know what? You don't have to leave so quickly. Let's put some positive spin on that news. And then all of a sudden the next day the markets are gapping up and people start chasing it. We call it FOMO, Chris, the fear of missing out. People start missing out on that upside. And I think, as far as from an investor's standpoint, and again, I tell you talk about this quite a bit from a long-term investor's viewpoint. It doesn't pay to panic and step in and step out and step in and step out. It doesn't really make a lot of sense to do that. You look at longer term trends, you look at the economy, you look at a lot of things that headwinds, tailwinds that some of these companies that we have are facing, and you stick with those regardless of what's happening in the short term.
Bob, you're speaking my language. Headwinds, tailwinds, I like it. What else, though? Right? Because I feel like in the past, you and I have talked about this just kind of, in various formats, videos that we've done, or more importantly, in the numerous offline conversations that we have, that we just need to adjust ourselves to the fact that there's going to be a constant push-pull, one step forward, one step back, as long as it seems the Trump administration is around. I'm starting to think more about the back half of the year. I know we're closing down the second month in the current quarter, but once we get into June, companies are going to report before too long. We're going to get another reset of expectations for the back half of the year. June also brings the, Fed meeting, and they're going to update their set of economic projections, right? And there's risk that the market, I won't say freaks out, right? The market, the CME Fed Watch tool seems to indicate 3, but, the Fed last time in March said 2 rate cuts. What are you, as we get ready for the back half of the year, what are you focused in on? What are the technicals telling you?
Well, before we get to the technical risks, now we mentioned about the Federal Reserve. Now you're talking my language. This is the sort of thing this sort of thing that I like to discuss and analyze, and because there's a real connection between what happens with the stock market, which is what we are all worried about, and where Fed policy is at. And Fed policy right now is telling us that careful stock market players, don't get over your skis. Don't be careful here, because if you do, we may not come in to save you. As years past, many have really thought that the Fed was there to save the stock market. They call it the Fed put. Well, is there a Trump put? I don't know, but I mean, as it relates to the Fed, I think that there's a real concern here that market participants are getting overdone right here, and not really understanding where Fed policy is going to be going over the next 6 months. I think inflation right now is still an issue that we have to address.
So I agree with you on the inflation, but it sounds, just to go back to a term you used a few minutes ago, there might be some FOMO in the market, right? People don't want to miss out, continuing to grind higher. I continue to think that we're not out of the woods yet. I think there's some hurdles that we have to clear through. Earnings expectations for the back half of the year, particularly for the market, and what that means for the implied, PE ratio or the market valuation. I do think that, the longer we go on without multiple trade deals, the more likely we're going to get conservative guidance.
Yep.
And some other factors, like what's going on with this big, beautiful budget, and tax exemption, tax extension, Are we going to get it? What form? Because the last I saw, it sounds like the Senate may not exactly pass something that Trump is happy with. So go ahead.
No, I agree with that, and frankly, there's a little bit of quite a bit of discussion and a little bit of disarray among the Republicans right now and trying to decide which version is going to work. I think the
Right.
Republicans are looking at it from the Senate point of view right now. It may not be completely exactly what they wanted, and the Congress and the president may want. So, at the end of the day, there's a lot of shenanigans going on here and a lot of horse trading, I suppose, going on here. But at the end of the day, is what is going to be passed in Congress here going to be helpful to the economy? It's going to be helpful to the stock market. I think right now the stock market is looking beyond that and seeing perhaps some resolution there. And I'm not sure if tax cuts are necessarily that great for the stock market. It's not bad, but it's not. They're certainly going to drive earnings power as much as people think. But we'll see what happens.
Yeah, no, I totally agree. I mean, I think coming into this year, folks were curious as to what may happen on the tax front. To the extent that tax cuts are extended, maybe there's some incremental room for those 2026 EPS estimates. Maybe some people accounted for them earlier in the year. Maybe they didn't. Maybe we'll see some movement. That could be helpful, right? But that's I would argue below the line and largely cosmetic, not necessarily reflective of true operating power. But we will have to see what happens. On your comment about inflation and the Fed, we've got a lot of retailers reporting this week.
Yeah.
ELF Beauty, one that a lot of people watch, came out and said that, hey, we've got a lot of products that are priced below $10. Last week they said we're going to raise prices on a wide array of products by $1 or more. That says 10% plus, price pop. Do you think we're going to see more of that? And does that have you worried? Hang on, does that have you worried about the data that we're going to get in the coming months, not necessarily the April PCE price index on Friday?
Yeah, I think this PCE, the personal consumption expenditures, which I know you follow very closely, so do I. It's one of the most favored inflation gauges for the Federal Reserve. They look at this along with the CPI and the PPI, Chris. But I'm a little bit concerned over here because we did hear different things perhaps from two larger retailers, Walmart and Target. We heard the Walmart CEO and CFO come out and say, you know what, we're going to have to take some price increases. And President Trump came out and was vehemently against that and said that they should, quote unquote, eat those tariffs. And
Right.
But Target didn't say that. They of course, they've got their own issues and own problems to deal with right now. So I'm really curious, Chris, to hear how our favorite retailer, Costco,
Mm-hmm.
reports and talk and discusses this situation on Thursday evening after the close. So it'll be very, very interesting to see what they have to say. I'm willing. I'm going to be in the camp of saying, Chris, that they're not going to pass those price increases on to their customers. They're more than willing to eat some of those prices, but they're already one of the lower end price retailers as it is right now, and even when price increases come up, the membership prices go up, people still shop there. I do, you do, so I don't think it's really that big of a that's going to be a big issue for Costco.
Yeah, if memory serves, Bob, you were just out in California and you paid a visit to a Costco.
I did, and boy, was it hopping at 10 o'clock in the morning on a Saturday in California. There was right when the store opened, there was a whole line of people, Chris, ready to come in and do some shopping and drop some money at the local Costco. So I think good stuff for Costco. I think this week when they report on Thursday.
Yeah, so BJ's reported last week, and their comp sales were pretty good. But the cool thing about Costco is they still report monthly comp sales numbers, and when you line them up, Costco continues to take consumer wallet share. We certainly like it, and I do think that the membership business model that they have really, really separates them from the pack, and I think we're going to see that start to show up even more in this earnings report and their guidance to the extent that they give it. So, Bob, any other companies, any other events that you're watching this week?
Well, we got one of the big dogs reporting this week, Chris, is Nvidia out with earnings on Wednesday after the close. I know Salesforce will also be reporting as well too. So I'll be really watching Nvidia closely this week because they tend to throw off a little what we call in bowling parlance, a little pin action to some of the other companies that are related to them. I mean, I'm looking at Broadcom. I'm looking at Marvell, which also reports later on
Right.
this week, and a couple of other names like AMD, Dell, also SMCI, Supermicro. Some of these companies, if I think Nvidia is going to bring out another huge beat this week and probably guide higher as they have been doing. I don't think their slowdown is going to be announced probably maybe for a few quarters down the road. I think they still have a lot of demand and in the pipeline right now. They've been talking about customers like Microsoft and Google and Meta even increasing their orders for chips, the Blackwell chips, and maybe even the next generation one, which comes out in about a year and a half. So I do think that they're going to be a huge driver, Chris, of with some of these technology names over the next couple of weeks. And as we move into June, it's a slower time of earnings, but still some big earnings reports going to be coming out, and I think that this is going to be a potential good driver for technology if their earnings are good.
Well, I'm glad you brought up Nvidia. It is the second largest holding in the S&P 500, the second largest holding in the Nasdaq 100. So, to the extent that the company delivers as expected or better than expected, the shares move higher. That's another reason to think that the market could move a little more up to the right, I believe, is the way we want the chart to go. But on the other hand, Bob, because expectations are running high, right? You are correct. Big tech has reiterated their capital spending. CoreWeave came out and talked about a big capital spending program. We're hearing about Stargate, not only in the U.S., but outside the U.S., the deals with the UAE. The only concern that I have is not necessarily for the quarter that NVIDIA will report. It's for something that we've seen happen with NVIDIA in the past, including the most recent quarter, which is there's always the consensus figure out there, right? The official published numbers, and the consensus amalgamates those across all Wall Street expectations. But it's the whisper number that you have to watch out for sometime, Bob. What for those who are unfamiliar with the whisper number, Bob, what is it?
So the whisper number, basically, Chris, and for everyone, is basically what is being rumored out there by analysts and participants and so forth. And there's some science to it. There's some non-science to it as well too. Maybe it's just polls. People just asking a poll out there. One of our colleagues, of course, Helene Meisler, does one of these non-scientific polls on Twitter, for instance. Where's the next 100 points going to come from the S&P 500? Is it up or down? So it's this sort of thing. So it's more of a consensus of where people feel and where they think that the numbers are going to be at. I would tell you that I don't think analysts have as much of an advantage in predicting where earnings are going to fall any more than you or I do. So, taking it all with the kind of a grain of salt, but certainly, there's no question that market participants and buyers of stocks do bid up stocks in anticipation of an earnings beat or earning expectation beat. So it's certainly that's always been the case with Nvidia. So to your point, think that maybe the stock has already been running up into that. To the print, into the whisper number. That's very possible, but I think that they tend to beat even the whisper number, Chris, every single quarter, and have for the past 12 quarters since 2022. So you know what? Why stop now?
Well, I'll take the other side of that, because even though we are long-term bullish on Nvidia, when they reported last time, they were a little short of the whisper numbers. Stock was down 7% the next day, traded off a little more the following days. Now, as a long-term investor, does that bother me? No, it doesn't, because if it hits certain levels, that could be an opportunity for folks who are underweight the shares relative to the portfolio to scoop up additional ones. So let me ask you, Bob, I don't know if you have the Nvidia chart at the ready, but if you do, where would you see some nice support for the stock on a pullback? where do you think folks should be, I won't say piling in, just given where the market is, but maybe nibbling, buying some additional shares?
So, Chris, it's having a little bit of trouble getting through 137. If it popped through 137, I think you're going to get a pretty good size short squeeze, and meaning that short sellers are going to have to cover their positions. There's been a buildup of short interest in this name over the past month or so. I've noticed it and have seen it happen. But by the same token, we've seen some nice gaps up in the stock over the past few weeks as well too. It started at the second week in May. So I would say a level that I would be looking at is where the 200-day moving average is right now. For instance, it's about 126 and a half. A little below there is a 50-day moving average, about 122. So if you do get lucky enough to get a pullback to those two areas, it's called 122 to 126. I would certainly be a buyer of that one right there.
All right. Well, I appreciate you answering my question on that, Bob. I think we should pivot and take some member questions. What do you say?
Absolutely, let's do it.
All right, let's do it. Here we go. Question one, Bob. This is right up your alley, Bob. What are your go-to technical indicators? I know we already talked MACD. You explained how important that is. What are some of the other ones that you rely on?
Well, one of my favorite ones is was created by my good friend Mark Chaikin Money Flow, and really basically it's an accumulator distribution indicator for volume and money flows. And so really what it tells us, Chris, is a big money investor coming into a particular stock or an index, and why is that important? Is because look, I mean, we know that a lot of the market action is being driven by algorithms and day traders and even day trade options and program trading. At the end of the day, it's the big money investors like the hedge funds, the pension funds, the charitable trusts, the mutual funds. This is the big money that is really moving markets and moving prices. 80% of the market is being driven by that. And Chicken Money Flow hits it right on the nose, Chris, and tells you exactly how the big money is trading or investing in a particular stock or in a particular market. So Chicken Money Flow is one of my favorites. I also like to look at momentum. Momentum, as it is interpreted by the stochastics. And what stochastics basically it's all about movement of prices up and down. And we
Mhm.
see these the money flows. We also see the price action, and I have to look at both of them together, Chris, and to get a good feel or get a good read and good analysis of where prices are going to be heading down the road. So overbought, oversold on the stochastics are a very important indicator for me as well.
Okay, let's go to our second question, and I'm going to tune this up just a little bit to give a little more context. So the question is, why is it important for stocks to test and retest technical support or technical resistance levels? And let me just add to it, Bob. You and I have chatted, and we've certainly written about this in the past, that when a stock either breaks through its 50-day moving average or pops above it, or the 100, the 200, it's got to retest in order to power higher. So if you can kind of explain that, that would be great.
That's a great question. And really, I'm going to use one word or two words to really explain this. And it's all about reference points. What is a reference point where we can find some reliability that a stock price is not going to break down from? And usually, when we see a stock make a sharp move to the downside and start to bounce or to rebound, we're looking for a pullback to that area to see if, is that a safe place to buy the stock, or will more people start selling and we'll see the trend of the market continue to the downside. And what I like to see is I like to see a pullback, a rally back up, and then a pullback to test that level and a rally back up. And it creates what we call, Chris, a W pattern. So if you think of the letter W, you come down, you make a middle, and then you come back down again, and then you come right back up again and we call that carving out the right side of the base. And we have a basing period where the stock is just going sideways, and that's sort of that W pattern going back and forth, down, up, down, up, down, up. So I want to see that sort of pattern play out over a long period of time. But that reference point is so important to make sure that there are no sellers down at that area or below to take that stock price down.
Okay, great. And let's tackle our final member question. Bob, you already mentioned, Costco, Nvidia as stocks to watch this week, but is there a particular sector or a particular stock that you're warming up to as we move into the second half of the year?
Well, I really like the banks, Chris, and I know in the Street Pro portfolio, we've got Bank of America, we've got Morgan Stanley,
Mhm.
and these names I think are going to do extremely well in the second half of the year, especially with interest rates so high. Their net interest margin is going to increase. Their borrowing from clients and from customers has been very strong. It's been robust, and although the companies have been more conservative in keeping some reserves in case of losses. It was noted by JP Morgan and Bank of America, Wells Fargo, and their last earnings reports in April. I think that by and large, this is the group that's going to really outperform in the second half of the year. So I'm glad we have some of those names in the portfolio.
I am too. I am too. I do think we've seen M&A activity heat up. I think, we're poised to see more of that. There's a couple recently priced IPOs, CoreWeave, Hinge, MNDT, if I remember correctly. We're going to see how they continue to perform. And I do think that the IPO, window could be opening. Obviously, the two names you just mentioned we have in the portfolio, extremely well positioned for that. So folks, remember, to have your questions asked and answered on the podcast, you have to be a Street Pro subscriber. Bob, as always, I enjoy our conversations. Before we get out of here, any parting words?
No, I'm looking forward to the month of June. It's often been said that summer rallies often kick off in June. Hopefully, it hasn't started already in May, but if it has, maybe it can continue in the month of June as we push into the summer months. And I'm looking forward to seeing where we finish this month and then get started into the next earnings season. Not too far off, Chris. It's just in July.
I know, Bob, you don't need to remind me of that. I'm well aware of the earnings season, trust me. But I will look forward to your insights and the other thoughts that you and I, tend to kick around on a day-to-day, week-to-week basis. So, Bob, thank you so much for joining, and I'm sure we'll have you back before too long. And folks, that is a wrap on this week's Stocks and Markets podcast. Be sure to give us some feedback in the comment section below if you're reading this on TheStreet Pro. And if you're catching this on YouTube or any other podcast platforms, a like, thumbs up, some comments, whatever you want to do, boy, that would be appreciated. We'll have another episode of the podcast coming your way before you know it.